Welcome back to Fast Market. I'm Alex Coffey in for Tom White, joined as always by the co-host of Fast Market, Kevin Hinks. Getting the band back together here today, Kev, on this Thursday. Equity markets sliding, drifting off of their highs, I would say, but still a very green day across the board with the E-mini S&Ps up 35 points on the session. Kev, we're going to continue our food conversation. Joining us now, just before lunchtime here in the Central Time Zone, is the co-founder of LikeFolio.com, Andy Swan, now with us. Good morning, good afternoon to you, Andy. Thanks for taking the time, as always. We were just talking some Chipotle, and I got to be honest, as I'm getting older, as I maybe don't go to the gym as often as I should anymore, I might even like Shake Shack more than I like Chipotle now.
Oh, it's top tier quality. This entire conversation and the last segment's making me very hungry. And we're not alone. When you look at Shake Shack, one of the things, now we've been bearish on Shake Shack actually since August, but I'm starting to change my tune on that based on LikeFolio data. We start looking at consumer happiness levels on Shake Shack. It's really outperforming the rest of the peers in a really big way. I'm not sure if this is due to people just being really happy to get back to a Shake Shack because some of them were in areas where their office was closed or they weren't able to get there, or if it's the quality of the food. I do think some others have been doing some cost-cutting type of stuff. So Shake Shack, really from a consumer happiness perspective, really outpacing its rivals in the type of way that makes a huge difference from a LikeFolio perspective on a longer term basis. Now, what we can't comment on, what we don't know, is the price of those ingredients and how much Shake Shack is getting pressured on margins. We think that may be significant, but we aren't experts on that in that. But what we can tell you is that, as of today, Shake Shack's really turned the corner in terms of both consumer demand growth and consumer happiness simultaneously as people get back into those offices, get back into those high-profit restaurants that were closed for so long. Plus, Shake Shack did a fantastic job of really putting together digital offerings, that delivery aspect of things during COVID. So they've kind of got the 1-2 punch now that satisfies everybody, and it's really showing in our data.
And it's been a long road back for this company off of the COVID sales. Like you said, they're in higher profile areas and their sales dipped. But now their last earnings report, they said comp sales were 2% over 2019 levels. They also, in October, Andy, raised the prices that management called a dramatic success. So like Chipotle, like the high quality fast food restaurants, they were again able to pass higher prices along to consumers without any major drop off. So is that how you signal turning the corner when they can raise prices and increase sales? How else do you look at these companies? How do you compare a Shake Shack to, let's say, the ultimate fast food, which we're going to cover in the next section, McDonald's? Clearly, it's higher quality, but it's also extremely higher ticket price, Andy.
Yeah, it's both. And I think you're right. When we kind of plot these out, we like to look for an outlier. Clearly, Shake Shack's an outlier on the happiness side of things. The higher on this chart, the more happy their customers are. The further to the right, the more year-over-year demand growth we're seeing. So Shake Shack's in the good section of demand growth, but really outperforming others in consumer happiness. And what that tells us is that this company does have pricing power, that they can raise prices without too much pushback from consumers. Because anytime we see consumer happiness levels at LikeFolio significantly separated from peers like this, it tells us that the company has a very loyal customer base and is very likely to get away with price increases and passing on those expense increases to the customers, so they have a better ability, most likely than competitors, to maintain their margins, although I think all of them will be under pressure.
Andy, building on that, we opened the show talking about some of the obviously concerns that are on the overall market. And while I'm sure you have thoughts on that, we don't necessarily need to get into the macro picture here. But You also talked about the rising cost element, and of course, no one expects or your data would have visibility into that. But an argument could be made from how I'm seeing this that it's now more important than ever to make sure that we're going to allocate capital to companies that have real resiliency. And I'd have to imagine that if your consumer is happy and you're still growing, and when they are passing on those prices, as they've disclosed that they have been, and it's not really causing major downticks in happiness, these are all things that if you're going through a checklist are probably making you feel a little bit more at ease if you're thinking about making a potential investment in, let's say, a company like SHAK. But it really across the board, I think it just stresses the importance of this type of data.
Yeah, I think it does too. I think it's really important to understand how these peers stack up against each other. Now, no one's forcing anyone to invest in fast food companies, but if you're going to, I think it's best to go with one that is seeing growing demand for its products and extremely happy customers for the reasons you just cited. It's the same reason you might prefer Netflix over other streaming providers from an investment standpoint, because they have that resiliency that I think is going to be so important as consumers start to get pinched economically, both at the pump and through inflation. Consumers have no choice at some point than to start cutting their budget a little bit and cutting things out of their budget. And the last things to go are those that make the customer most happy. And that's the thesis here, and that's why we really like to highlight on shows, on your show especially, these outliers compared to peers, because I think that's the most important thing to understand when you're looking at a sector.
Andy, as we close things out here, I want to pick your brain on one tie-in between this industry and potentially what we're seeing in the economy and these trends that you follow. And I know that you guys are, in tune with this stuff in terms of how money is being spent and shifting. If we are, going into a situation where we're going to watch our pocketbooks a little bit closer, watch our bank accounts a little bit closer, is that typically historically been good for companies that are in this fast food space, or do we tend to be a little bit more cautious and conscious of where our money is going, maybe go to the grocery store more?
Yeah, I think there's an argument for both, but I think the first thing that you're going to cut is the more expensive sit-down type of meal, the more expensive evening out. It could actually shift people towards, a higher quality fast food option like a Shake Shack or like a Chipotle. So I don't see a huge impact there. Budget shuffle, we'll have to see what the consumer does, but historically it's pretty muddled when you start talking about fast food companies. Now, on the higher end dining, you do start to see some significant drift as inflationary pressures or budget pressures start to hit the consumer.
Good stuff. Andy Swan, the co-founder of LikeFolio.com. Always a pleasure. Great insight, as
Thanks. Good to
always.
see you guys.
All right, Kev.